last class, and we'll be examining non-current asset turnover. It measures the rate at which non-current asset of the company generates sales revenue. So just non-current asset, now talking about the fixed assets, the long-term investment of the company. I'm measuring it to see how much of the non-current asset was employed, or the capacity and the utilization of the non-current asset or fixed asset to generate revenue only. No other asset but the current or non-current asset. It measures the effectiveness by which the company is putting its non-current asset into use to generate revenue. So the effectiveness, talking about the major capital injected funds into asset is generating revenue, because that the fixed assets are capital intensive in nature. So you want to see how the revenue covers the non-current asset or fixed asset purchased in the company. So the formula is as follows: revenue divided by your non-current assets. We'll still look at what it means, or the kind of assets we are talking about. The ratio measures the efficiency the company is using, like we said, the fixed assets, which are long-term assets, such as PPE, investments to generate sales. It provides insight into how well the company's long-term investment contributes to revenue generation. So non-current assets are long-term investments. Most of them span 10, 20 years. So you want to see on a yearly basis how much you're generating revenue with them. So the revised formula is net sales or revenue divided by the average non-current asset. So the average is always a good picture to look at the beginning and the ending divided by 2. But where you don't have comparative years, you can just pick the normal figure for your calculation. So the net sale is looking at revenue after you deducted other direct cost or essential deductions from the sales, like refunds. And also the average looks at the beginning non-current asset and the ending non-current asset divided by 2. Very, very important. Okay, so let's move to our example. As we've been doing, I believe this is a very simple ratio and it's direct. So I'll do 2020, you help me 2021, 2022.
I'm trying to look for the
okay, the question.
Yes, it's
Kabiru.
I don't know how come I can't find this. What happened now? It's something that I've been.
Maybe a lot of what do they call it? A lot of posts have overshadowed that one.
Yeah, but I usually see it. I don't know why it's not coming. Dan Kabir.
Yeah.
That's what I've been looking for since. I don't know how come.
Maybe I'll share it. Then we have to make do of the screen. Then I hope you're able to see the font on the screen.
I'll find it. It's here now, so it will be fine. It will be found.
Okay. As you are searching, let me be doing the first tier so that I hope before I finish, you would have gotten documents. Okay. So let me continue with the first tier, following the formula on the screen. So let me take my revenue, which is net sales. Net sales is my revenue. So let me go take that for the first year. That will be my SCI. So for 2020, I have 1.320 billion. 1.3 billion. Then
it's never, I don't know, it's never a problem to find it. I don't know why today is a problem. Hey. Today.
Oh, calm down, you find it.
It's never a problem.
Yeah. Just take your time, calm down and find it. Okay. So may have taken my sales or my revenue And let me go and pick my non-current asset. So my total non-current asset for the beginning is.
I mean, did somebody remove it from here?
No. Nobody has the right to remove anything from there. It's only admin that can delete. Nobody can delete or remove. Okay. So I'm still calculating. I now have my non-current assets for the beginning and the end. Okay. So let me change the beginning and end. All right. So let me get the average of the two. So average current assets.
How come nobody has joined? You said they did not. How many people did the test? The mock
The
exam.
mock exams for case study, I think about 4 people got
That's
4
good.
straights. Yeah, 4 people did it. I did like
We're usually 4 anyway, so.
okay, and even the people that used to join the call didn't. Most of them didn't do it. Though. 2, I think, were on the call, and 2 are not consistent on the call. Alpha, have you seen the question?
I can't believe it. Somebody has removed this thing.
No, I doubt. I doubt
Why
as
can't I
much.
find it? It's always here.
I doubt as much.
Oh, I now know why. I now know. Okay, because advanced.
Okay, you are checking in advanced taxation.
The link for today's own under advanced audit.
Oh, okay. Instead of
instead of yes.
Yes, instead of case study.
Yes. Exactly. That's why.
I was the one that caused the confusion.
Yes.
So sorry.
Maybe that's what people are waiting for.
I
Maybe
guess
they are waiting for the link.
Yes. No wonder you're the only one on the call. Okay, I've deleted it. I've taken it back to case study.
Exactly.
Sorry about
That's
that.
why.
It's too much work that scattered my head.
That's correct. It's not. So I will find it.
Yeah.
That was where the confusion started from.
Exactly. Okay.
So I'm sure they will soon start joining.
Yes, I guess as much. All right, so let me calculate our for the first year non-current assets turnover. So that will be sales revenue divided by our average non-current assets. That will be 3 times. Wow. 3 times. Incredible. So we have non-current assets turnover. Have you seen it?
Hey. So what's happening today? I cannot see it.
Are you sure you're in case
study? I'm in case study. ICAN case study. Yes.
Okay. So
this thing is distracting me. I've not been able to focus to see what you are doing because I'm looking for it.
Don't worry. Let me quickly share it again. I think that will make it. I'll make it easier. Let me share it again if you've not seen it. Yeah, I think I've seen it faster than you. So,
Have you seen it?
yep. So I've shared it again.
Okay. 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 So let me go back to today.
Exactly.
Maybe I went too far. Okay. Thank you.
Okay. All right. So
So
I have 3 times for the
so what is required is the
2020.
total non-current asset. What is required for this formula?
Okay, so let me put it on the screen for you.
So it's net
sales divided by your average non-current assets.
What's the name of this formula? Efficiency
Or activity ratio. So this is
non-current assets
turnover. Yep.
Net sales, that's the turnover, right?
Yes. No. Your revenue. Yes, your revenue. Revenue or your sales. Anyone.
And it's net because you're removing any income that is not for the business, right?
Exactly. Like refunds or discounts received.
Yes. Then average non-current asset is opening plus closing.
Exactly, divided by 2.
Okay. So it's just the financial situation report we're using now.
Yes. You're right, too. Salmat has joined.
Yes. So
You're welcome to the call, Salmat. Yes, I've done for 2020.
Okay, so I'll do for
2020.
You're welcome.
My question.
Good evening, Salmat.
Good evening. Oh. You do your assignment.
I didn't see your assignment. Julia has submitted. Salmat has not submitted.
Oh, Julia, I'm so proud of you.
Assignment
you gave us.
Oh my goodness.
It's been stressful.
I had to. I said to myself, I don't want to start like this.
I told myself to the same thing. I said
I don't want to start like this. No way.
I have my cover page. I have some appendices.
I don't want to give myself any excuse. If you notice, I submitted it very early in the morning, like past 12 midnight. So
yes, I saw it. I saw the time you submitted it. We are not yet done with the solution. So Salmat, you can submit before Thursday. We'll be looking at it on Thursday. Okay, tomorrow is audit, so you can submit before then.
Okay, sir. Okay.
Yeah.
I'll work on it.
But tomorrow is audit, and tomorrow we're
looking at it. So that question, I can't wait for us to solve it.
Yes, it's very pepperish, right?
Hey, God, I beg.
I'm glad it's coming now, so that no matter what the examiner brings, you are ready for him.
Yeah.
And it's good that we continue to practice, so it won't be a problem.
Exactly. Yeah. That's the idea. Exactly. All right. So we are looking at non-current asset turnover. What are your figures? So Salmat, get ready with your calculator to engage too. 2021, 2022. Julie, what did you get?
Just a minute. I'm having 2 points.
I was waiting for the link.
Yes.
2.39.
It was Julie that called my attention to my mistake. I went to post it on audit instead of case study.
That's 2.4. 2.3, that's 2.4.
Okay, 2.4 times. Okay.
Then the other one is 2.4 as well.
2.4, okay. Times, okay. Fantastic. All right. So let me validate the figure so that we'll look at the next one with Salmat. All right, so for revenue, I'll just take these two only. Come here, thou post. Then for non-current assets, I just take these two. Come here, I'll post. So this would be for ending, and this would be for beginning. And this would be for ending, and this would be for beginning. Okay, so let me just drag this. And these 3 times, let me just drag it. Let me see if it is correct. Yeah, so it's now up to 5, so 2.4 exactly. So 2.4 times, 2.4 times. So Excel approximated it for us. That's fine. Okay, I think it's a simple formula, and from their performance, it seems their revenue is above their non-current asset or their fixed asset. Shows the company is doing well under this metric. Okay, so let's look at what it needs very importantly.
I'm trying to take the formula.
Oh, okay. Yeah, don't mind us. We're running, but then it's one of the simplest efficiency ratio. So
yeah, it's not that serious. Yeah.
Yeah, it's not that tough. Okay, don't worry about the formula. I will share the slides. Julia said I should even share.
It just shows how do you interpret it? What does it mean? It shows how well the non-current assets are being utilized. I don't know how utilized. Okay.
Yeah, so it shows how much the revenue of a company generates for each unit of currency. So every naira that was spent on current assets invested or non-current assets. Yes, non-current invested. So it shows how much was used to generate revenue. So
looking how much of the non-current asset was used to generate revenue.
Exactly. Yes, exactly. So revenue was generated 3 times the total amount of current assets. So if your current asset is 3 naira or 1 naira, revenue was 3 naira above your current or non-current assets. That's simply what it means. Very, very graphically. So the higher ratio means that you are utilizing your long-term investments effectively. Non-current assets are long-term investment, not like current, that is a monthly, quarterly, or at most 1 year thing. So this one spans 5, 10, 20 years, some assets even 50 years. So a higher ratio shows that the company is utilizing its asset effectively to generate money, revenue, while a lower one suggests inefficiencies in asset usage. So where we have like Dan Kabiri's case now, if we have less than 3 or less than 2, less than 1, then the company is not utilizing its current asset, its non-current assets effectively. That's what it means. Now, the implication is that a higher non-current asset indicates that the company is effectively using its long-term asset. Of course, we've said that to support revenue generation, yes, while a low ratio implies underutilization of asset. Meanwhile, the company might not be getting enough return on its long-term investments in those assets. So what is the cause and effect? A high non-current asset turnover, like we just saw, 3-2-4-2-4, means efficient use of fixed assets, well-managed operations, high production, and sales volume related to the value of long-term assets. Exactly. So these are the causes. When operations are well managed, the assets are producing at high capacity, and sales volumes reflect the production. It shows the long-term assets are being utilized effectively. And what are the effects? Improved profitability, better returns on investment, and efficient capital allocation. Exactly. So profitability improves when assets are used and revenue is generated in line with the asset in use. Also, a lower one is clear. The causes are underutilization of outdated assets, low sales volume, overinvestment in non-current assets that are not needed without proportional revenue generation. So the balance and the optimal usage of the asset is very, very necessary to mitigate these costs. And the effect is when there is a lower total asset turnover, it culminates in lower profitability, increased carrying cost of the asset. So the carrying cost of the asset based on the IFRS 13 becomes higher than the purchase cost of the assets, showing potential need for asset revaluation or optimization. So it's necessary to use those assets at optimal capacity to generate revenue and for production to earn a lot to avoid these effects. So in conclusion, the non-current asset turnover is a vital indicator of how well a company's long-term investment contributes to sales performance. Of course, you bought the assets for sales, you bought the assets to employ them for production and revenue generation. So once they are not doing that, then something is wrong. If revenue generation is the goal, then the asset must be used to full capacity. And a high ratio reflects efficient use of the asset, leading to better profitability, operational efficiency, while a low one shows the need for the company to improve asset utilization to enhance financial performance. So the non-current asset is a very clear metric, and I think it's one of the easiest. And the examiner tests it frequently. He tests this non-current asset. Yeah.
But do they really ask for the ratios? They just tell us to analyze it, right? They don't really ask for the ratios to use.
Sometimes he even calculates it, then provides an industry benchmark. So he'll calculate it and give you the industry benchmark and say you should interpret. And if you look at some of his other or some of his past questions, you also see he ask you to calculate and interpret at the same time. Yeah. So he likes this ratio, and it comes out very frequently. So take note of it in your practice session too. It's very simple. It's just your numerator as revenue and your denominator as fixed assets. Average. Yes, the average. Yes, but if you have just 1 year financial statement, just use that year. If you have comparative trend or 3 years ahead, that's where you use the beginning, ending, and get the average. Exactly. Any questions on non-current asset turnover ratio? Is a simple ratio, in my opinion.
It's okay, sir.
Okay, it's fine. All right, so let's run. We move to inventory turnover. Okay, one of the tricky ratios, but also nice. Inventory turnover measures the number of times an inventory is brought or bought and sold or used in production during the year. So you buy inventory, or if you're producing raw materials, finished goods, raw materials, work in progress, finished goods, the cycle ends up in inventory. And the turnover looks at the number of times inventory is bought and sold or produced during the year. It's calculated as cost of sales divided by average inventory, where the average is beginning and the closing, and your cost of sales is your cost of goods sold. Alternatively, it can be termed inventory holding period. Remember, we calculated this at the inventory or the liquidity ratio. It's also an activity ratio, but I termed it liquidity to make it different. So that one was in days. We did the one in days. Now this one is a reverse. This one is how many times. They are both activity ratio, but I like stratifying it as liquidity so that I can differentiate them. So one is in days and one is how many times. So just how we have it calculated under operating cycle like we did in the last class. It measures how efficiently the company manages inventory by indicating how many times. So take note of this phrase, times. So it's not days now. Inventory is sold and replaced over a specified period. So under exam condition, if you calculate that of the days under activity, you are correct. If you also do it under liquidity, it's fine. But appropriately, most textbooks will tell you they are both under efficiency or activity. How many times inventory is sold and replaced over a specific period, typically 1 year, is what we are measuring here. It assesses the effectiveness of inventory management and is crucial for ensuring that a company is not overstocking or understocking inventory. So inventory is one of those fraud areas financial accountants, chartered accountant hide some fraud. So it's a critical ratio because if you notice external audits at the end of the year, they want to know what is your inventory valuation. What did you value as your inventory? And that's why a stock count is done at the end of the year. Full stock count, though the external auditors may just do sampling, but then as internal auditors, I do full stock count to ensure that the value that is reported in the inventory column under the current asset is correct and not overstated or understated. This is very important. So take note of it. It's an area you should talk about, and the examiner tends to bring questions towards this side where we have scenarios of overstocking or understocking of inventory. You see where management maybe inflated the inventory figure just to hide some deficiencies there. So take note of this particular metric. So candidates will notice that there is a relationship between operating cycle discussed earlier and activity ratios. Exactly. So the reason is that the same data used in calculating the ratios is the same we use here. It's just that we transcribe or juxtapose them, the numerator and the denominator. The denominator comes down to the numerator and the numerator go back to the denominator, just like that. So for example, the number of days inventory measures how long the inventory stays in the store of the company. So the 365 days one we calculated, the number of days shows how many or how long inventory stays in the store before being sold. While inventory turnover measures how many times in a year inventory is purchased and manufactured and sold during the year. So it's very simple to understand. So let us assume that we have a number of days or inventory days of 45 days, 1 month and 15 days. This means that inventory turnover in the year will be 365 divided by 45, which is 8.1 times. That is 365 divided by the number of inventory days, just looking at a scenario of the calculations. And it's also equal 365 days divided by inventory divided by fully cost of goods sold times 365 days. So if you do that, you still arrive at cost of goods sold divided by inventory. The formula is clear. We have it as inventory turnover ratio, which is cost of goods sold as your numerator and average inventory as your denominator. The cost of goods sold is your total cost of production, producing goods or goods produced for sales during a period. So is either cost of goods sold or cost of sales. While your average inventory is your beginning and your ending inventory. So let's run. It's a simple ratio. I like it because it's direct. So let's go to our cost of goods sold. Let me do year one, and I'll pick our average inventory from the Dan Kabir question. Okay, so from our SCI, we have our cost of sales for 31st December as 1.1 billion. So I'll post our cost of sales here, remove the negativity. Okay, so let me pick my 3-year financial. Exactly. So please, if you have any question, permission, please interject so that we can. I'm trying to rush up because we have so much to cover. We are still in chapter 2 and we are rounding up February. And we have about 11 chapters to cover. We have mock exams also, so we need to run faster.
I have 21 and 22.
Wow, that was so fast. That was so fast. Okay, let me say average inventory before I take your figures. Inventory beginning. Just model them an average inventory ending. Okay, so we now have let me go back to the formula again so that I can pick the right. Okay, so I have our average inventory. Okay, so let me quickly pick our beginning and ending. Permit me, Julia, I'll take your figures quickly. Inventory, current assets. Okay, so our beginning, ending, let me just take all of them. Since Julia has calculated everything very, very fast. Okay, so let me have this as ending. I'll take this as beginning and the ending. Okay. Okay, so let me get my average. This divided by 2. So 693 divided by 2. So our inventory around. Okay, so Julie, give me your figure. What did you get?
I got 3.05 and 3.11. That's 3 times.
Oh, is it for 2020 or for 2021?
21 and 22.
Oh, okay. 3.05,
and 3.11.
Okay. Do you have the same figure, Salmat?
Yes, sir, we have the same figure.
Okay, fantastic. So let me get my first figure. This divided by this. I have 3.17.
Yeah.
So let me cut this and validate your figures. Okay. So if you guys have the same thing, let me just validate and run to my... Oh, I went and pick sales. I'm supposed to pick cost of sales. I beg your pardon. Okay. Negativity. Okay, that's fine. So this would be our ending. This would be our beginning. This would be our ending. This would be our beginning. Fantastic. Okay, so I just drag. Exactly as Julie and Salma said it. So I think Dan Kabir is doing very well from his net asset turnover. I think he only did bad in his total asset turnover. He did below 1. But if you look at his net asset turnover, he improved. Non-current asset turnover, he did better. And now his inventory turnover is also doing not bad. 3 times is good. Okay, so let's see what that means. It means that this shows how many times the company's inventory is sold and replenished during the period. And if you want to understand this graphically, so in 2020, he turned over his inventory 3 times, sold and replenished 3 times, which is good. In 2021, he did the same thing 3 times, 2022, 3 times. So there were no stock. There were no stock pile in the store. There were no inventory that were not moving out. So it's a good scenario for Dan Kabir. And the higher ratio like we have indicates that inventory is being sold quickly, which can indicate efficient inventory management. But another thing you will see is that from his days inventory holding period days, it was longer. Why? Because the inventory that was used was the inventory that had not been received in cash. I hope you took note of that. Did you notice that? Because if you look at the inventory days we calculated, it was longer. But how comes the turnover is better and it shows how many times? It's because the cost of sales was very high and it shows inventory was moving out fast. from his cost of sales, height, and how it covered the average inventory by the year. So if you compare them with the 365 days average inventory, you see that both results are different. He did better in these times and did worse in the inventory holding period days. So take note of that, so that under exam condition, when you are asked to interpret both of them, if both results, one is in dichotomy to the other, maybe one is favorable, one is unfavorable, you'll be able to understand why and explain it graphically. So while a lower ratio suggests that inventory is moving slowly, which might lead to excess stock, a higher one shows that inventory is moving out fast based on what we've calculated. And the implication is that a higher inventory turnover implies the company efficiently manages inventory levels, avoid excess stocking, and reducing holding, storage costs, and so on. So a low ratio could indicate poor sales performance or overstocking, leading to increased storage cost and potential expiry, obsolescence, obsolete stock, and all that. What are the cause and effects? A high inventory turnover, like we've seen, shows strong demand, efficient inventory management, or quick sales cycles. While the effect of a high inventory turnover ratio is reduced holding cost, improved cash flow, less risk of obsolescence or expiry, but might lead to stockouts if inventory is too lean and is moving out. So it may lead to stockouts in the sense that inventory may be needed or stock may be needed and they may not have because it's been sold. So they need to be producing very fast where you have a high inventory. And a low one shows excess inventory, weak sales, poor inventory management, or slow moving products. This could be the cause of a low inventory turnover. If we have it lower than 1 in the case of down cabin, this could be the cause. While the effect includes increased holding costs, cash flow constraints, risk of inventory expiry, and also potential write-offs. You may have to write off expired inventory based on IAS 2, write them lower of cost and net realizable value. So in conclusion, this metric is essential for assessing how well a company manages inventory. This is very important. A higher turnover reflects efficient inventory management and strong sales, while a low one signals inefficiencies that can negatively affect profitability. So apart from the receivables and turnover and the payables, this is a very important metric you should take note. And the examiner frequently tests this, especially when it's a full-fledged inventory or manufacturing company question. So companies, chartered accountants should strive for balance. So most of the ratios, balance is the key. Ensure that you have enough inventory to meet demand without excess stock to tie down your money. This is very important. So that word balance should come in when you are interpreting these ratios. Okay, so we are fast. I like this speed. Any question on inventory turnover so that we can run? I believe it's self-explanatory, no need for too much explanations. Am I right? Everybody's quiet.
Yes,
I hope
you're right.
Okay. All right. I thought I was talking to myself. Where is Julie? Julie is quiet. I hope she didn't doze off small. Hello, Julie. It's only Salmat I had.
Sorry?
I said, I hope you didn't doze off small.
Just for 1 second.
Because we are usually quiet. I guess as much.
For 1 second. Just for 1 second.
It's only Salma that responded to my inventory turnover. But did you grasp the concept of inventory turnover? Is clear, right?
Yes.
Okay, fantastic. It's a simple ratio, and I like it as one of those activity ratios. Okay, so let's run to trade receivables turnover. measures average or the average number of times credit sales. So this is credit sale only, has nothing to do with cash sales. Same way with the receivable collection period of this. So this
I thought we have done this already. Haven't you done it?
no, this one is receivable turnover. So the one we did was receivable days. This one is how many times? Yes. That's why I stratified that one as working capital or liquidity. So I brought this one here as activity, though this is the main activity anyway. So this one is looking at credit sale and how many times customers have paid or pay throughout a year, the cycle in a year. So, but it's looking at the credits alone, the credit sale. So it measures how efficiently a company collects its receivables or the credit it extends to customers. It shows how many times. So you remember the other one is how many days. Now this one shows how many times during a period the company collects its average accounts receivable balance. It's important because it evaluates how effectively the company is managing credit exactly and collecting payments from customers. So the formula is clear. Just like the other one, we have the numerator as average trade payables divided by credit sales times 365. No, this one is credit sales divided by average trade payables, where your credit sales is the credit you provide for the year, your total credit for the year, and the average receivables is the beginning and the ending divided by 2. So very simple ratio. I just hope Dan Kabir does well in this computation. So get ready to engage 2020-2021 and let's run very fast. So Salman and Julie, you guys should begin calculation as I'm doing my own. I love the way you guys calculated it.
So they didn't give us credit sales. So is there credit sales? Is there any?
Credit sales is the same thing as the revenue now.
No, it's 20% of total purchases.
They said something, but
yes, please go ahead, Salman. I'm listening. Yes.
The total purchase yearly is 80% was
exactly 25%
and 20% on credit.
25
of the total revenue received. Of the total revenue yearly is 85.
She has gone off. I can't hear her again.
15% now that will multiply by the revenue. Oh, can you hear me?
Yes.
Is it the remaining 15% multiplied by the revenue?
Yes.
Okay.
Exactly. So I like your thoughts both on this. So the caveat there states that total revenue is 85% was cash and the balance is credit. So we now have our credit sales based on 15%, not 25%. It's 15%.
15? It's 25 now.
85 minus 100 is
15.
Oh, it's 15. Oh, see, 15. 15. Yeah.
Exactly.
The good thing you corrected.
Yeah. Okay, so let me go and pick all the revenue figure and take 15%. Let's do our computation together. I'm glad we are both engaging. This is very, very good. Okay, so let me calculate. Let me quickly arrange my account receivable beginning and ending. Okay, so my account receivables for beginning and end. Okay, so I've arranged my figures. Let me have my average accounts receivable. I have both of them divided by 2. Just drag them. This to my total. We look at the formula again.
Getting 0.42 and 0.43.
Okay. So let me validate that.
Yeah, now you are not joking. No. It's like I using your laptop because this your calculation is fast.
Come again?
I using your laptop because this your calculation is super fast.
This calculator, as far as this, the laptop is it's slower. So calculator is faster because it's just a short calculation.
Yeah.
Yeah, so I knew this result was going to be bad. I knew. So what did you get? Give me for 2021, 2022.
0.42 and 0.43.
0.42, 0.43.
0.43.
Salmat. Yeah, Salmat, is that what you have too?
Please hold on, please.
Okay, that's what you have too. .4, 0.43 is to 1. 0.42 is to 1. 0.43 is to 1. Salma, please confirm that's what you have also.
I am on it. Please give me some minutes. Thank you.
Okay. All right. So I think we have the same figures with I have the same figures as 2020 with 2022 that Julie have. So 0.43.
Yes, I got the same thing, 0.42, 0.43.
Okay, fantastic. So both of you are on the same page. Let me drag and see. Yes, exactly. So we're on the same page. Now, if you remember, Julie, in the last, the days class, you remember the account receivable days was about 800. You remember?
Yes.
So definitely, definitely the turnover is going to have issues. It's not going to be up to 1. Because that receivable days we used credit sales, and this one we're also using credit sales. So we just changed or swapped the denominator with the numerator. So definitely he must have hiccups with this, showing he's not even up to 1 time. He's able to cover his collect his receivables in a year. So of course, this must be a challenge. All right, so let's look at what it means quickly. What does this mean? It means that it shows how many times the company collects its receivables during a period. So in a year, they couldn't even collect their receivables once. That's what it means, not even up to half. Because if you look at the result, it's showing 0.43, not even up to 0.5. So there's a challenge with their receivables turnover. And the higher ratio suggests that the company is collecting receivables efficiently. That's what it means. So this one now we have 0.43 is the reverse. Is the lower ratio may indicate difficulties in collecting payments. So with the 365 days activity or liquidity, whatever we called it, showing over 800 days, that we even shouted, aha, this is not nice. You can see it's also showing the same results here in the turnover ratio, indicating difficulties in collecting payments or inefficient credit policies. And the implication is that the company has efficient, where there's a high receivable turnover, maybe it's above 1, 2, 3, like we saw in the inventory turnover ratio. If it's above 1, 2, 3, shows that there's efficient credit management practices and quick to collect payments from customers, which improves cash flow. And another thing that may make them lax to collect the money is because if you look at the percentage of the cash sales, it's very high. Their cash sales is about 85%. Yeah, so maybe they just felt, we have collected our money in billions, so whatever it is, less. But then no matter how low the credit sales is also good, because IFRS 9 has made provision for expected credit loss, and they don't want to lose that credit to bad debts or written off losses, no matter how little it is. So maybe they have a policy of 85% cash, then an amount that can be allowed to let go. But no matter the policy, it's still good to ensure that you recoup your receivables in due time. Maybe if they have it as 50-50, 50% cash, 50% receivables, maybe they will take their receivables turnover seriously. Who knows? So that's another angle I'm looking at it from. All right. So the implication is that where the receivables is above 1, 2, 3, implies that the company is efficiently doing well in its credit management practices and quick to collect payments from customers, which culminates in cash flow. Why a low ratio, like we saw in this case, indicates customers are taking too long to pay. So the 365 days we saw over 848 days. Where we calculated it, how many years are increasing the risk of bad debts and tying up the company's cash and receivables is very risky. What are the causes? The causes of a high receivables turnover above 1, 2, 3 is caused by strict credit policies, efficient credit processes, and efficient collection processes, or strong customer payment discipline. These are the causes. And the effects is clear: improved liquidity, better cash flow management, and reduced risks or risk of bad debt. While lower receivables turnover is caused by lenient credit terms, exactly. So when the company is too lenient with its terms, and they look at the policy and the proceeds from credit as low, or poor collection practices, or financially troubled customers, this could be the cause. And the effect is increased risk of bad debt, strained cash flow, and higher working capital needs. Exactly. Especially when a chunk of the sales between cash and credit is high, especially on the credit side. So in conclusion, the receivables turnover ratio is a vital indicator of a company's effectiveness in managing its credit, sales, and collection processes. A high ratio demonstrates strong cash flow and credit control, while a low one signals potential issues with collection or collecting payments. So maintaining an optimal turnover ratio ensures that a company can manage its cash flow effectively while balancing customer credit needs. Exactly. So balance. In fact, in all the ratios, your interpretation, you should use keywords like balance. Balance will help you earn marks, because in all the interpretation of the ratios, I notice balance keep resurfacing. So take note of that word and use it in the interpretation of your ratios. Okay, so that will be the end of trade receivables turnover. And do we have any question? Wow, 9 on the dot.